my guys in the second part of the video. So in this particular session, what we'll be looking at is the requirement number 2. Okay. So what we've been asked is that how quoted co company or customer contract should be accounted for in consolidated financial statements of Humming's Co, which are presented in dollars for the year ended 31st December 20x4, right? So that means dollar, that means it has to be converted as well. So where is that intangible assets thingy? There was something, I think it's in acquisition, should be in acquisition. It's over here. Excluded from this fair values are several contracts with customers of Cocheco. The contractual relationship prohibits the customers from obtaining services from any other competitors. The estimated fair value is 15 million, right? At first Jan, right? So it should be converted as well. Let's write that down as well. So as per IFRS 3, business combination, the investor should value all the or should identify all the investees identifiable net assets at acquisition date at fair value, right? So what to be identifiable, what you would say is, in order to be identifiable, it's as per that thing, okay? So that is as per intangible assets. So what we could write is that, I'll just have a look at that as well, just to confirm a bit better. Right, non-current assets 77. So what I am trying to look at is the identifiable is of course legal, or like if it can be sold separately, right? So I just wanted to get the wording correct, okay? So okay, an intangible assets is identifiable if it is separable, that is capable of being sold or used, right? Being used or sold separately. That is what separable means, right? Or it arises from contractual or legal rights. Right, that is one thing, and then after that, these also mean that even if the investee has not recognized the assets in its individual statement. This also means that the parent should recognize even if the purchasing or investor should recognize the assets even if it has not been thingy in its individual statement, right? So next statement that we will be making is that in case of co, the entity has contractual or legal, or it's like legal right to prevent the entity from purchasing goods from rivals and the value can be measured reliably, right? Therefore, a separate and should be recognized at the fair value of 15 million grommets, since the value is in foreign currency. It should be translated to dollar on 1st Jan 20x4, 1st January 0x4 or x1, what is it? And the parent recognizes it using spot rate. That is, I think, 1:8, right? Just copy and paste this thing. Oh shit. $1 equals to 8 grommets using spot rate. That is, how much will it be? So let's just use our calculator. It's using Chrome. 15 million divided by 7 or 8, right? 1.875, 1.875, 1.875 million. What the dollar? And during the year, if the useful life of the intangible asset can be determined, then it should be amortized over its useful life, and also tested for impairment annually. Alright, should be amortized and then should be impairment tested as well. The impairment and amortization cost is usually translated using the average rate, right? Because it happens over the year, so can't really use any other values. So the carrying amount of the asset at the year end would be divided by 7, I think so. Yes, 7. 2.1428. 2.1428. Dollar 2.1428 would be translated using closing rate, which is basically $1 equals to 7 units, and that is this figure, right? And the corresponding increasing, so since it has increased from 1.875, so minus 1.875, okay, 7 minus 1.875, 0.2678, 0.2678, 0.2678, and a corresponding increase in within equity under the heading foreign exchange reserve, right? Or transmission reserve, whatever. Forex reserve. Forex reserve. Okay, that's one thing. And then second part is very interesting. Okay, so that's where the fun part is basically. So what we've been given in this second part is that, so we need to calculate the goodwill, I think. So yeah, the calculation of goodwill on acquisition of Crochet co-accounted for Humming's co blah blah at the year end include a brief explanation and calculation of how the impairment net differences on goodwill will impact the consolidated financial statement. Right? Okay, we will do that. So first of all, I'll do goodwill calculation. Calculation. You know what? This is easier in seats. easy over here, right? Working on one over here. So calculation of goodwill. So first thing that we'll have is consideration, right? NCI at acquisition, or you could just say value of NCI, right? Then something will come, and then after that, what you do is less net assets. Okay, here is the big deal over here. I don't know if you've done this kind of question before, but so since what we've been given is that Hollings Co purchase, okay, that's not Goodwill Co, that's Critch Co, right? So fair value of the NCI is measured on 1st Jan, which is 6 million. Okay, so paid cash of 24 million, right? So what I'll do is I'll just write this figures in dollar million, dollar million. Okay, so 24 and then 6, right? So this figure should be basically this minus this 18, right? And then after that, what has happened is, what's the net assets? Net assets. So there's two net assets, I think. So yeah, 43 and then 50 million, right? So 43 and then 50 million. So these are not in dollar million. These are in grommets. Hang on a second. Hang on a second. Okay, these are in dollars. So that means we need to either translate, or we should translate it to grommets, because we have determined it to be thingy, right? So what's the translation rate? It's 8, I think. So yeah, should be 8. So 24 into 8, and that's for first, and then 6 into 8, 48, right? So we got this particular value. Okay, so NCI at, so first thing that I'm looking at is NCI 43 million grommets. It's pretty easy. So 43, I can just write it down. Right. So some of the net assets are in dinars as well. So we need to convert that as well. Okay. So in this case, what has happened is 50 million dinar is over there. That means 50, and then what's our rate of translation? So rate of translation should be Goodwill at acquisition. Date is this much. So let's do a foreign exchange kind of thingy as well. So accounting for the differences. Gromits. Second thing is exchange rate. Next thing is it'll go to dollar after that, right? So to opening balance, BD, and then is there any impairment? Yes, there is impairment. Oh no, the impairment. Yeah, there is some. The goodwill has been reduced by 30%. I think so. Where was that? Where did I see it? Yeah, 30%, right? So impairment for the year. So always don't be confused that the impairment should be done using thingy closing rate, okay? And then after that, what we'll have is we'll leave one space for the translation gain or loss, right? And then to closing CD, right? What's our Gromit's opening balance is 82. Our exchange rate is 8, I think so, yeah. And then 82 as well, 7. Just divide by this, and then same thing over here as well, same thing over here, right? And then what's the impairment? 30%. This figure into 0.3, 24.6 less impairment equals to this minus this. Goodwill at reporting date. Okay. This figure will be this minus this. 8.2, right? And then what's the exchange rate, average exchange rate for the year? That's a dinar, right? So divided by 7. So there is no thingy average, right? So let's just put in 7. So what do we get? This minus this should give us some figure, right? This minus this should give us 6 point something. So that means there will be a gain. So this minus, and then I open the bracket. This minus this 1 point something something. That's our translation gain, or you could just say exchange gain. Okay, and what we should always do is that whenever we are doing this, what's the thingy rate of a year? How much did you acquire? 80%, right? Okay, so impairment allocation. You could just say impairment allocation, right? So first thing will be for parent, second thing will be for NCI, right? So in this circumstance, what we'll do is just copy and paste this thing, and then just for impairment, no, that's for exchange. Exchange gain, right? So it should be allocated between both of them, okay? So it's 80%, 20%. Copy and then paste. So what we should be doing is that basically I'll just select this impairment for the year, right? And then I'll just lock this cell as well. Okay. Oh shit, man! I closed it. I pressed Alt F4. I should have pressed something else. Anyways, so let me just do it again. That strategic business report in March 2020, right? That's that, and then untitled spreadsheet. That's that. Yeah, it's saved, right? So this figure into, okay, let's just lock that cell as well. Okay, that's been locked now, and then do that, right? So copy and then paste. In this circumstance, not that, but this one should be locked, and then into this figure. All right. Okay, that's all done. What has happened with the Goodwill calculation is just right over here, right? Yeah, so, so yeah, just all we need to do is just explain this thing, okay? So basically, what we can basically say first of all is that, so since that figure is right over here, so what we can say is the net assets of 15 million bromines, the contractual, I mean the intangible assets, that is not recognized, or that isn't included within the net assets should be included because as per IFRS 5, at the acquisition date, the purchasing entity should Nice. All identifiable assets. That's first thing, right? So the net assets would be 43 million grommets, 43 million plus 15 million grommets, and the net assets of in dinar should be converted first, should be converted to grommets as it is our functional currency. So how much figure was that? Where did that thing go? The dinar over here, right? So basically 15 to t. So opening rate was the right 1 dinar equals to 2 grommets. 1 dinar, 2 grommets. That is 15 to 2, right? 100 million grommets. Once the goodwill or once the opening goodwill has been computed, goodwill has been computed using the computed, it should be translated should be translated to parents to presentational currency of parent, that is dollar, the opening goodwill should be computed using the spot rate, that is basically $1.8 grommets, right? Grommets, that is how much? 10.25 million, right? That is $10.25 million. Now I can write dollar. And the impairment for the year should be translated using the average rate, that is dollar $1 equals to 7 grommets, and that is how much will that be? 3.571, 3.51, right? 3.5. That is $3.51 million. And a corresponding or in the exchange gain of 1.46 million should be recognized in other comprehensive income. Right. The comprehensive income. Other comprehensive income and the exchange gain of blah blah should be recognized, and it where will it be recognized? Otherwise, if it is for individual thingy, it will be recognized directly in SOPL, okay? In other comprehensive income, right? Last but not the least, the impairment for the year and exchange gain should be allocated to parent and NCI as below, right? So what I can just do is let's just copy and paste this whole thing. Yeah, that's pretty much it, right? It's providing them that should do the job basically. Oh shit. Okay, yeah, so that's pretty much it. That's how we answer this kind of question. B number 2 is also done, right? Now we will just be looking at question number C in the next video. So since I don't want to make this video too long, right? So C and D we will be looking at that. So that's for Quebeco. That's pretty simple, right? And then the calculation of bonds, that's a little bit different, but we'll definitely have a go at it. So enjoy your day, enjoy the questions that you're solving. Until next time, bye bye, and don't forget to like, share and subscribe.